Welcome to the 2023 editions of Arendt UCITS Webinar Series. The UCITS, and I would say the whole financial industry, had a turmoiling year due to obviously market conditions, but also some challenges and uncertainty from a regulatory perspective. But despite all of that, the UCITS have shown a big resilience and a constant growth, which is obviously very good news. The purpose of these webinars this year will be to give you some insight on these new trends, going through topics around distributions, prep skids, and other regulatory change that will shape the market over the next few months. Today, we are going to start with one of the topics that has probably kept us the most busy over the past almost 2 years now, which is ESG. So ESG and partly the Sustainable Finance Disclosure regulations has kept us on our toes with the inception of level 1 SFDR, which was in May 2021, and obviously the December 2022 deadlines, where we all struggle to see how we could comply with these new regulations with all the information that we had. And what is very interesting is to see that what started as a pure compliance exercise is really a tick the box exercise, which was around, is that applying to my product or to myself as a financial market participant? How should I put the informations? How to best reflect my strategies into these formatted documentations? As slowly evolve into with the insight and with the gain of expertise, has moved to a more strategic considerations. And we've seen the asset manager through some of the changes that sometimes maybe have been perceived negatively, with some downgrading or revisiting of their disclosure. But I think this is a signal of more maturity for the market and a better understanding of what these regulations were aiming at. So today we're going to look at these opportunities and also obviously some of the risks that comes with these regulations around ESG. And with me, I have two of my colleagues, two experts, which will help me to entertain you for the next 40 minutes. Antoine Portelange, who is a supervising associate within Arendt working on the UCITS, and among others, I should say. And also Mick Feierheisen, which is a senior advisor working in the regulatory practice within Arendt. So maybe as a starter, and starting with you, Mick, I think if you could maybe walk us through the recent and future topics on the matter of ESG, and also what our clients are looking to and looking forward to, maybe.
Yeah. So I think the general and a very simple message is investors still want Article 8 and 9 products. This didn't change over the last 2 years. So there's still an appetite for these products. If we look at the Morningstar report from the last quarter, we can also see that a lot of inflows were made into these Article 8 and 9 products. So it's just a commercial opportunity as well to sell your products better. And if we just look a bit at how the products look like, they still differ a lot across these product categorizations. And I think the most difference we can even see in this Article 8 categorization, which is kind of the broadest categorization. And here we really see strategies from basic exclusion strategies, which are, I would say, rather simple to implement, up to very sophisticated strategies, a combination between exclusion, best in class. And sometimes these even look very close to an Article 9 strategies because they are so sophisticated.
That's actually a very good point you're making. I think that obviously for all the ESG deniers or the one which are against all these regulations, the move that we have seen over the past year from Article 9 to Article 8 obviously has been strongly advertised and put negatively in the pressing, or they cannot do it, it's too complicated, or asset managers have gone beyond what they could promise. So what you seem to be saying is that, well, not really. I think everyone realized this is a disclosure exercise that you have to do, and somehow having an Article 8 with what we call 8 hybrid or is serve you better, is more close to the effectiveness of your product and your strategy without altering the underlying. Is that what we've seen?
Yes, indeed. I think there was a big fuss about these big recategorizations, especially from Article 9 to Article 8. I think it's also mostly related to the fact that initially, the SFDR and the whole disclosure regulation and on all the ESG regulations, it has been very new to the market, right? So I think we saw some defensive approaches where it's just, okay, let's first stick to the lower categorization, Article 6, maybe a few products, Article 8, sorry. And we saw then, of course, other asset managers which were much more aggressive, and they said we immediately go, all our categorizations, all our products are Article 9 categorized. And I think now, and it just shows that the industry is understanding this whole regulation more. And this is, all this clarification, Q&As, etc. It just led that the market knows better where to categorize, so to say. And I think that's why we saw a lot of recategorizations. We had this publication also, this clarification on sustainable investments. There's still a lot of questions, but the clarifications led indeed to asset managers being better able to categorize their products. And this Q&A, I think, is a very important one. It's European Commission Q&A, where it has been really clarified that SFDR remains to be a transparency and a disclosure regulation, rather than really a regulation which sets minimum requirements. And like I said, we see for Article 8 products the wide range of strategies, and that's exactly because of this reason. Now, and I think that's also a big opportunity for the market, is that it has been clarified as well by the CSSF and the European Commission that when we now look at sustainable investments, there is no specific minimum requirement. Of course, you need to comply with the definition in SFDR on a sustainable investment, but you're still free to define how you assess contribution to an environmental or social objective. So I think there's a lot of room for interpretation, which is a good opportunity, and everybody can still, as asset managers try to get alpha, they will now also have their own strategies to define sustainable investments.
And I think so. Now that we have the product disclosure, right? Obviously, we need to push that in the market. One of the other piece of the regulations that was modified is MiFID. Where do we stand on that one?
Yes. So now MiFID was amended to actually add sustainability preferences to the usual suitability assessment. So now actually what will be added is that investors or potential investors will be asked on three basic sustainability preferences. The first being if the clients wants the product to make sustainable investments, and if so, the minimum percentage of those. If the client wants the product to have a minimum taxonomy alignment, and lastly, if the product should consider principal adverse impact indicators. And here, this is really where we are going. So it has been clarified on several occasions, the SFDR is a disclosure regime, and the product categorizations should not be seen as labels. So even if the market currently still sees it a bit as a label, I think discussion started off with clients still want Article 8 and 9 products. The direction goes into these three big pillars: sustainable investment, taxonomy, and VIEs.
Right, and let me put again my ESG deniers cap or being against these regulations. What we hear in the market is that, right, it's good, but actually, first of all, we are very difficult market conditions. So what investors want mainly is returns, and I think people would care a bit less in the planet. Sustainable investments for if I have to sell this as a product, it's difficult to understand. Taxonomy line probably even worse, and PAI considerations, maybe the worst of all. Nonetheless, I think are we seeing on the PAI side? I mean, we heard that more and more service providers are in the capacity to provide data, and do we see this more taken into account by asset manager in their products?
Yes, indeed. I think really of these three sustainability preferences where we really see the most move is really on these PAIs, exactly as you say, probably because data is becoming more available. And as well, of course, this leeway to define how you consider PAIs is also an opportunity in this regard. And then, of course, the other two sustainable investments, I think there we are not that far yet, especially because it was always a big question about how should we assess sustainable investments as indeed taxonomy at economic activity level, or can we do it at company level as we see a bit under the SFDR, the market doing for the moment. This has now been clarified, so maybe there's more to see now. And then on the taxonomy part, I think this is a really difficult one because it's very stringent and also their data is missing, and we generally see rather low taxonomy alignments. But of course, these three preferences, it's probably where the direction will be going. But the initial step we see indeed PAIs for the moment, yeah.
Right, and hopefully, as you mentioned, I will discuss with Antoine right after. But the directions of the market and the underlying economy, is being pushed by the commissions. There will be more and more opportunity and targets for asset managers. So we can hope for bigger conversions, having these taxonomy aligned products becoming more and more mainstream. So Antoine, we're trying to have a good picture being painted out. Some opportunities, trying to look back at your disclosure, looking at your strategy, and see how you can best accommodate that and put that to your investors. But obviously and we've heard there are some risk. Greenwashing is, and I think will continue to be a big topic for this market for the years to come. So what the people following this webinar, what they should be aware of, and what they should be maybe worried of in that respect?
Yes, sure. So I think, as you said, when everything started in terms of introduction of new regulations and so on, everybody saw ESG and SFDR as a big marketing opportunity. And the main risk at that time was to be basically left out of those recategorizations. And now that the market is getting more sophisticated, they're starting to look at what is actually meant under those disclosures. And when I say market, I intend to say also investors and regulators. And so now that people are looking into the details, some risks indeed arise, and some market players realize that they might have been too far or too quick in their disclosures. And of course, in a very regulated world like UCITS, the first risk and the first actor we think of when we think of risk is the CSSF. And I think we can summarize the CSSF approach to ESG and SFDR more specifically, because that's maybe the most relevant for UCITS, in 3 steps. The first step, and I think it's the same also for asset managers, they saw SFDR as a pure compliance exercise. As you said, the most important at the time of level 1 SFDR and level 2 was the deadline. We must be compliant in Luxembourg by the deadline imposed by the European level. And so at the time, the CSSF relied a lot on self-certifications. So they asked asset manager, do you think you are compliant with the regulation? And they said yes. Not a lot of major blocking points on CSSF applications. So it was going very smoothly because the important was the deadline. And during this first phase as well, I think it's very important to say that the CSSF, and like all the market, like actually ourselves as well, they have built a strong expertise. So they've been working a lot with the industry, with ourselves, to better understand how does the regulation work. And everybody was looking to understand how it works. So everybody was like feeding themselves with some insights, some interpretation of the law to really come up with a good understanding, good interpretation of the SFDR and the taxonomy. And now that this is done, so step one, it's pretty much still ongoing. Even for us, I think there are still news to come, and so we still have to adapt ourselves. But once you understand the law, step two of the CSSF, let's say, approach has begun. And it's really data gathering. It's really understanding what is the market doing in terms of ESG. So beyond the disclosures, what are they actually doing? And for that, they are starting a data collection exercise that most of you probably know already, which is overreaching, basically. It applies to all asset managers dealing with Luxembourgish products. So for Mancos, in terms of UCITS, it's going to be Lux Manco, but also non-Lux Mancos for Lux UCITS. And for all the sub-funds, being Article 6, 8, or 9, so really overreaching. And by the way, if you've not seen it, the deadline for this data collection exercise has been postponed a bit. So I think it's on a best effort basis by mid-June, and in any case, by the end of October. Exactly. So yes, so step two is data collection. So you have a good understanding of the law, step one, step two, data collection. And with those two information, we are now looking at step three, hopefully, which is really going into the details of what's happening operationally in Luxembourg with asset managers. And in that respect, of course, the purpose of the CSSF will be probably, I think we are also looking at the future, but not really, looking at making sure that the Luxembourg market is still secured and everything is done properly. And so you may have seen also that the CSSF has published its supervisory priorities in April, in which we can see what they are going to do in terms of sustainable finance in Luxembourg. And for Mancos or UCITS, I think the three most important points would be organizational arrangement with a specific focus on sustainability risk integration, so through human resources and governance as well. So point one. Point two is checking again the compliance with the disclosures requirements, because again, in 2022 and 2021 as well, they relied on a self-certification form. Now they will go again and look, they will reopen prospectuses to see whether it has been done properly. And they will also check consistency between all the documents that are publicly available. So that's the second point. And the third point is portfolio analysis. So really looking into the portfolio of funds to see whether they comply with what they have announced in the pre-contractual disclosures, And for that, they have announced, not in that specific press release, but I think to many clients, that they will also perform on-site visits. But this goes along. We have to check with everything has been done properly. And so for the step one, it's going to be looking at policies that are in place. And so it's going to be even physical on-site visit like they do usually, but they will integrate ESG aspects. Also website visits, so looking at what has been published on the website. Is it consistent with the pre-contractual disclosures? And also any other publicly available documents. So for example, for the portfolio analysis, you know that in the SFDR level 2 reporting, you have to give your top holdings in portfolio. And so they'll be able pretty easily to check whether those top investments are compliant with the contractual rules that have been announced in the prospectuses.
So I think, it's fair to say, because obviously, and partly, I think the data collection exercise, creates some tensions on the market. I mean, it's very busy already on the regulatory front with a number of reports. Now, the way you explain it, and I think this is also the way I've perceived the relationship and the way the regulator has evolved. I think, first of all, I don't think the CSF has created any gold plating for Luxembourg. I think they were very much, as you said, between listening to what the market was saying, but also very much listening to what ESMA was providing as guidance, and also learning all together to come to the best scenario for us. And again, with I suppose the view which is making this UCITS market, that is Luxembourg, a safe place to do business, and where your products are not going to be challenged. And what you have described in terms of steps, data collections, and then on-site, and then whatever the regulator does is very I would say, a normal process of what we have seen for other topics in Luxembourg. So, hopefully, I mean, my hope is really that all of this again will bring us to say that we do have a market that is secure, where we've done our best. We all contributed to that, and for putting out products that are compliant and are aligned with the European Commissions. I think one of the other topics, which is CSSF related, and that is probably of interest and discussed in the market, is the 0277. Can you maybe shed some light on that one?
Yeah, sure. It's very, very hot topic. As you said, we talk about it on a daily basis almost. And it comes from the fact that every commitment you make in your SFDR annexes are binding, and they are actually as binding as any other commitment you make in your prospectus. So you give investors a document, a pre-contractual document, where you say, I'm going to do this, this, and that. And it could be a lot of different actually policies. So from exclusions to a portion of sustainable investment. So even the asset allocation that you plan and you disclose is binding, because you say to investors, I will invest at least 5%, let's say, in sustainable investment. So investors invest in your fund based on those information. So you must respect them. And if you breach your commitments, we are looking at first a commercial risk, of course, but also a liability risk, because again, it's a pure contractual breach. And so in that respect, we've been talking a lot about what should I do if I break my commitment. And it could be an active breach, but also a passive breach. And this we see a lot because data is evolving a lot, and our clients, they rely on data providers. And so perhaps they give an ESG rating of X, and then in a few days, they reassess, they change a bit the policies, and the rating changes. And so because of this change, you don't respect your asset allocation anymore or your investment restrictions anymore. And so the question was, should we apply 0277? And for those who are not super familiar with all the numbers of CSSF circulars, the 0277 deals with NAV calculation errors and investment breaches. It is super important for UCITS in Luxembourg. And it gives some procedures. So how should you react when you breach one of your investment rules? And strictly speaking, the 0277 does not seem to apply to ESG restriction because it's not stated like that. And many market players have said, well, I will not apply the 0277. And to be perfectly transparent, currently since it's not perfectly clear, they are right to do it. And we've been involved also on working groups on the update of 0277. And apparently it's currently not intended to regulate ESG breaches through the 0277, but we never know. It can change. And by the way, there is a very nice webinar coming I think in September, October by Arendt on the update of 0277. So stay tuned for that. But still also, CSSF can also deal with that matter in the CSSF FAQ and SFDR. So it can change. But yeah, so some market players have said, well, it's too burdensome. I will not apply the 0277. But maybe we can also think about that from a more positive standpoint. As I said, if you are breaching a contractual commitment, you are civilly liable for that breach. If you fall into the 0277, well, you are a bit more protected as an asset manager and ultimately as the board of director of the fund, because you fall into one of the procedures foreseen by the CSSF and you know already how you should deal with it. So maybe it can be burdensome, but it can also be more protective. So you need to also think about risks and opportunities. And I think because there are a lot of discussions, we would be also very grateful to have your feedback on the topic. So if at the end we have some time, do not hesitate to share in the comments what you think about that, because it's still evolving a lot. But yeah, so one of the big topics currently indeed.
Yeah, and I think as you said, this is always these questions around do I want to be called by a CSSF process, but somehow that give me some boundaries and guidelines, and indeed are maybe protected from other liabilities. Or do I want to escape this because of some very good reasons? But I think in terms of partly if you are on the passive breach side, I mean the 0277 is not very burdensome.
Not at all, yeah.
So that point for considerations for the audience, right? So these are, I would say, I don't like to call them risks, but obviously some of the all these regulations, again, in our view, will bring some opportunities. As Mick said, we see still asset flowing into Article 8 and 9 funds. I suppose that all of this also has put back into perspective what is the integration of sustainability risk was in that context that everyone should do, and I think here that you also have a topic. So once we have that in mind, and I think you've already Mick mentioned already that taxonomy. So what is on the radar? What is coming that will reshape? I know there are a lot of discussions. Obviously, I think we appreciate some of the changes, but not too quickly. So what is coming? What is boiling up for now? What is going to be there on the market in the next 6 months?
Yeah, so I think to start with what we already talked about, taxonomy, maybe you've seen it, I guess you have. We are now looking at the technical criteria for the 4 remaining objectives. So as you know, for the moment, we only had technical criteria to assess whether an activity contributes substantially to the 2 first objectives of the taxonomy, which are climate change mitigation and climate change adaptation. But now we received the draft delegated acts for the 4 remaining objectives. So this will extend, let's say, the scope of application of the taxonomy to topics in relation to use of water, pollution prevention, biodiversity. So it will get even more interesting because we can now tackle more activities. And still about taxonomy, I think another point we wanted to mention is the social taxonomy, which is a topic that has been dormant for 1 year now because the final report was published last year by the Sustainable Platform, and since then it was pretty calm on that side. But because we are getting closer to the end of the environmental taxonomy, maybe they will reactivate the social one. And again, new challenges, new activities to be tackled, and new potential sustainable investment. And the third point I wanted to mention, again, in relation to the social aspect, I think we all know that currently ESG is pretty much E and then SG, because we are always focusing on the E aspect, the environmental aspect. But we might also look somehow and at some point at the switch from the E to the S of ESG. We are seeing a lot of initiatives at European level that are towards more human rights integration and social matters. So, for example, the social taxonomy, of course, but also CS3D, so the Corporate Sustainable Due Diligence Directive, so CSDDD. So yeah, maybe that's a window that opens on new matters and more social-focused matters.
So an opportunity for asset manager to expand their strategy and and for products to be more sustainable, and also maybe with the more E and S, we won't have to make the distinctions between what is E and what is S, which I think also was and is still a question for us. Right, so taxonomy, obviously a big piece. The other point, Mick, I'm turning to you, that I think we wanted to talk about again, and because, as you've mentioned previously, this is very much something that asset managers are considering, either because they have to at entity level, but also that they want to and have integrated in their product. It's the PI. Do you want to say some more on PI?
Yes, I think it's something that is very close in the future, let's say. It's very short term. Because under the SFDR, because before we talked about this PIE consideration at product level, but actually you can also consider PIEs at entity level. And if you have more than 500 employees on average per year, you're actually obliged to consider the PIEs, or you can just opt in to consider the PIEs. Now, there's a deadline, 30th of June this year. So if you opted in, or if you're above this threshold and you consider PIEs, you will now, by 30th of June, need to publish a full report on this consideration of PIEs, including the data in these regards, but as well as actions taken, actions you plan to take. When we talk with our clients, we hear that this is a difficult task. First of all, data is still an issue, even though PIE data has increased lately. But you need to calculate this based on 4 calculations at the end of each quarter and then average them. And of course, if you only start capturing the data now, it's going to be difficult. And you have this whole template to complete, which there is no market practice for the moment. And we assume that really due to the difficulties, that this year it will be really trying to do a best effort. These PAE statements won't be perfect this year. Of course, this will evolve over time, especially considering the CSRD, where we will have companies being obliged to provide data on these PAE indicators, so the quality goes up, etc. So that's a big deadline. If you decided to consider PAEs, or if you have to, that's a big deadline you need to keep on your radar for sure. Another thing to keep on your radar, which I wanted to mention, is the joint consultation paper, which suggests amendments of the SFDR level 2. I think we were all very happy that, we had SFDR level 2, this whole template is a bit out of our way. But with SFDR, there's always something new around the corner, that's for sure. So now this joint consultation paper, it's just a consultation paper, so nothing set in stone yet. But it suggests actually to, again, amend the templates. We already had the amendment with the new taxonomy graphs, in February. And now it again suggests to amend the templates with the aim to simplify the templates. But there's also a big change in the templates, of course, from looks-wise. But then they also have a whole new section, or they suggest a whole new section on greenhouse gas emission reductions. Where there will be also detailed information provided if you have such a strategy. There's no requirement to have some. For example, on intermediate targets, final targets, and if you use, allowances, etc. So there's a whole new aspect on this. So really something to look out for and get commercial opportunity maybe, having strategies with greenhouse gas emission reductions. And another big point, what was the suggested change in there is amendments to the PAEs. So what they suggest is to have new PAEs, both mandatory ones as well as optional ones. But they also amend some of the existing PAEs. You will see there's a few cosmetic changes just to clarify what it really means. But then also because some PAEs were a bit open-ended, because the formula on how to calculate it and the definitions were not actually clear. So they try to clarify this in this amendment now as well. So this joint consultation paper is really something to look out for. Again, it's a joint consultation paper, so nothing set in stone. So it will still take some time until it will be implemented. I think until the consultation ended, end of this year. Then we still have another year at the European Commission level, giving also a bit of leeway for implementation. So we assume that there will probably be, not before the end of 2024. Yeah. So it's a whole new thing, and people get annoyed that there's new templates again. But I think it's still a long way to go. But
obviously a number of group ALFI, and EFAMA is working on this, and I guess this is for us an opportunity to, as you said, like we've grown, we understand better, we have the expertise now, and so we can feed that back to ESMA and to the Commission with the hope that they will hear the industry in terms of what did work and what didn't work, and so we can only take the opportunities and eliminate some of the risks, and particularly towards regulator or investors that we have mentioned. Right, so I think all these obviously regulatory development on the ESG points have kept us really busy, and as you've heard, we'll continue to do so for the foreseeable future at maybe and hopefully a reduced pace, so that we can focus on the business, which is to put out products for investors and manage these. I have to say that obviously the market conditions and high interest rates have potentially played adversely against ESG products also, because you have, and what we hear from clients, that obviously there's the big interest about the returns more than anything else in these conditions. Now, as we see the underlying economy evolving, and we think that opportunities. I think asset managers also think that opportunities will lie in this business of the future, and so that taxonomy aligned activities are the ones where you will have the growth, and that's where you will be able to bring some innovative ESG products to your client. So, again, this ESG regulatory journey is obviously far from being over. And as you mentioned, we have the consultation paper. I think the Commission is still looking at a new regulatory framework, which again hopefully will push and help the growth of the UCITS market. So that's it for us. I think we do have the time for a few questions, if we have questions from the audience. I'm looking at the... one of the question is around so we've seen again, because that's something that really strike me, this move from disclosure under Article 9 and coming back to disclosure on Article 8, but maybe more, I would say, more detail or more elaborated. What has been the point of view of your client? I mean, from like really, what was their journey towards this? Was this really like, oh, we've been too far, or we didn't understand that, or can you share with us maybe some practical expertise that you have? Maybe starting with you, Antoine.
Yes. So I think there are two big points here. The first one is indeed better understanding of the regulation. I think last year people realized that Article 9 funds must have only sustainable investment. It has been clarified by many ways. So you have, of course, a little bit of other investment that you can have in your portfolio, but let's say that the 85% or 90% of your portfolio should be sustainable investment. And at the time, we did not have clarity on what is a sustainable investment. So there was this obligation to have only sustainable investment, but we didn't know what a sustainable investment was. And so at first, as Mick said, I think Article 9 was a super marketing product. Well, we are hyper ESG, we are almost impact funds, we do Article 9. But then, okay, we have to do sustainable investment assessment on all our targets, which means also PEI assessment on all targets. And this became to be a bit stressful for clients, which say, well, I might not be able to have 90% of sustainable investment. So most of them started to recategorize as Article 8 hybrid, which is an Article 8 with a very nice strategy. Whatever the strategy is, as Mick said, it can be exclusion, but also very enhanced ESG strategy. But so it's going to be Article 8 plus some sustainable investment in the portfolio, but not 95 or 90% of sustainable investment. And by doing so, they kept the same strategy. So they did not really change their ESG appetite. They just realized that with a 8 plus or 8 hybrid, they would be able to have sustainable investment to meet some of the MiFID preferences and to avoid any risks linked to the fact that they were not sufficiently composed of sustainable investment for Article 9 products. So that's the first point. And then the second point, but which is pretty much correlated, it's then the risk of reputational damage, because we've seen some articles in the press for Article 9 funds that were showing themselves as Article 9. They were compliant with what they were saying in their prospectuses. So from a regulatory standpoint, let's say they were in line with their contractual engagement. But then when you look at the portfolio, it's basically the same as an Article 8 or a non-ESG fund at all. And so, yeah, they were put it out on the market as, well, maybe too green to be real. And in that context as well, it led some market players to reconsider their positions.
Yeah, I've got a feeling that the demonstrating the contribution, the positive contribution, is always something that asset manager achieve. It's more the do not significant harm that seems to be a trouble. Is that something that you would?
Yeah, indeed. I think the do no significant harm is a bit more difficult because you need to take into account these 14 mandatory PIEs at least, and any relevant. And indeed, initially we had a data issue in this regard, whereas for the contribution part, you can define it yourself. So you can look at the data you have and define a strategy based on that. But this do no significant harm was a whole new principle which was introduced with the SFDR. And I think also coming back on what Anton just said, is that with SFDR, we really see in our discussions with the clients that it's not the SFDR which poses the biggest risk, it's the reputation, right? So it's really about being in the newspaper, having allegations on greenwashing, etc. So this is really a big risk. And that's what we see our clients struggling as well when we discuss with them on potential categorizations, what they actually do, what's behind the scenes, what they do. And then it's always the question, okay, how aggressive do we enter the market with this? How much information do we provide? Because we don't want to be in the newspaper and then, you know, being alleged that we do greenwashing. And also something which was actually published last week in this regard is the ESA's progress reports on greenwashing in the financial sector. And we see very well with this publication as well that there's something happening to really detect and define what is greenwashing. Of course, now their common high-level understanding is, of course, it's misleading information or misrepresenting information towards the public. So that's very basic, but there is also works on this. So reputation still plays a big role in this regard. Another thing I think the whole market was struggling with was the pace. The pace of all these publications. I mean, we had SFDR level 1, everybody was happy that finally we have it out of our way, and then we had level 2, and then the templates were demanded. In between there was taxonomy deadlines, you know, so a lot to cope with. Yeah. And that just within the last 2 years. So, and this is also what we see with this joint consultation paper. The feedback we saw from the market in this regard was really that it is too fast, it is too early. They are all scared because CSRD only enters into force in a few years, so they are scared that they need to report the PAs where they don't have the data. You know, pace and reputation, I think, is the two big things.
Yeah, thank you, Germain. I think this is, you know, really rejoin some what I can, you know, see with my clients that you know, they actually do a lot, but as you said, we've been caught with pace, and obviously reputation risk is a very good, a very high point on the agenda. So, you know, to end up on this note of you know, trying to look forward, look at what's coming. I think we, you know, still need to be as an industry innovative, and hopefully you know, the commissions will follow. I will show you for what's coming up your way. So you know, in June you will have a UCITS Pre-Kid update, some discussion in benchmark also end of June, and then you have a webinar on distributions early July, and just before you go in holiday, super interesting also topics on cost and charges. So don't miss these four your webinars coming your way before we hope all going to enjoy our long, well-deserved summer holidays. Thank you very much for your attendance and participations, and we're looking forward to see you next time.